Hello, and a very warm welcome to the Mindset Lab. I'm Nora.
And I'm Marcus. It's an absolute pleasure to have you join us for our very first episode.
Marcus, can you believe we're finally here? I feel such a sense of fresh beginnings, almost like spring itself. Outside my window, I can see the cherry blossoms just starting to unfurl, painting the city in delicate shades of pink. It's a beautiful reminder that growth is always possible, even after a long winter.
Indeed, Nora. And that sense of renewal, of potential unfolding, is a perfect metaphor for what we're going to discuss today. Just as spring rain nourishes the earth for new life, understanding financial literacy nourishes your financial future. It's about planting the right seeds and knowing how to tend to them. Exactly. Today we're diving into the mindset of wealth, decoding market trends. We'll introduce you to some fundamental concepts and the essential vocabulary you need to start reading basic market signals with confidence. Think of this as your foundational understanding, your spring planting for financial insight.
So let's cultivate some knowledge, shall we? Marcus, when people first start looking at financial markets, it can feel like a totally different language. Where do we begin to simplify this complex world?
We begin with the fundamental cycles, Nora. Markets aren't static. They move in phases. The two most commonly discussed are the bull market and the bear market.
Ah, the classic bull and bear. I always picture a bull charging upwards and a bear swiping downwards. Is that a good way to remember it?
It's an excellent mnemonic, Nora. A bull market is characterized by rising stock prices, optimism, investor confidence, and economic growth. People are generally buying, expecting prices to go even higher. Think of it as a period of financial sunshine and blossoming investments. People are happy, they're investing, and they feel good about the future.
So a sense of positive energy, a flourishing economy. It's like when everything in spring just seems to be waking up and growing rapidly. Everyone feels good. Everyone sees potential. So what about its counterpart?
In contrast, a bear market is marked by falling stock prices, pessimism, and investor fear. It's when the market is declining, often by 20% or more from recent highs. Investors are selling, worried that prices will drop further. Imagine that bear swiping down, or a financial winter where things feel colder and less certain.
So if a bull market is about growth and optimism, a bear market is about contraction and caution. It's crucial to understand these fundamental directions, isn't it, Marcus? Because our emotional response to them can be so strong.
Precisely, Nora. And understanding these cycles helps us avoid making emotional decisions. When you hear financial news, knowing if experts are talking about a bull market or a bear market helps you frame the conversation immediately. It's the first step to decoding the signals.
And these markets rarely move in a straight line, do they? There's always an element of unpredictability. Which brings us to our next key term, volatility.
Volatility refers to the degree of variation of a trading price series over time. In simpler terms, it's how much and how quickly a market, or a specific stock, moves up or down. A highly volatile asset experiences rapid, large price swings. Think of it like a spring storm. 1 minute it's sunny, the next there's a downpour, and then the sun is back out. It's fast, it's unpredictable, and it can be intense.
That's a great analogy. So high volatility means a lot of movement, sometimes up, sometimes down, and very quickly. Low volatility, then, would be a more stable, predictable movement?
Exactly. Low volatility means prices are relatively stable. For many long-term investors, lower volatility is often preferred, as it implies less risk and a smoother ride. But higher volatility can also present opportunities for those who understand how to navigate it, though it comes with increased risk.
So navigating volatility requires a certain mindset, doesn't it? Not just knowing the definition, but understanding its implications for your investment strategy. It's about building resilience, both financially and emotionally.
Absolutely. And understanding volatility helps you prepare for the ups and downs. It's part of the market's natural rhythm. You can't stop the spring rain, but you can carry an umbrella. And speaking of consistent rhythms, let's talk about something many investors cherish: dividend.
Ah, dividend. I love this word. It sounds like a little reward, a bonus for being patient and committed. So, if I own shares in a company, and that company is profitable, they might give me a dividend? Is it always money?
Most commonly, yes, it's a cash payment. But sometimes, companies can issue stock dividends, meaning you get additional shares. The key is that it's a regular income stream, often quarterly, which can be particularly attractive to long-term investors or those looking for passive income. Precisely. Mastering these terms is your first step to actively decoding market trends rather than passively reacting to headlines. It's about cultivating that mindset of wealth, moving from confusion to clarity.
Now that we've laid the groundwork, let's move into some practical hacks. How can our listeners, the global urban professionals, start using this knowledge to actually read market signals? What are some actionable steps, Marcus?
Great question, Nora. The first practical hack is to consistently read reputable financial news. Don't just skim headlines. Look for keywords. If an article talks about optimistic investor sentiment or record highs, you're likely in a bull market. If you see phrases like economic slowdown fears or significant corrections, it points to a bear market trend.
So it's about context, isn't it? Not just isolated words, but how they fit into the broader narrative. It's like feeling the atmosphere, the overall mood of the market.
Exactly. Second, pay attention to the major market indices like the S&P 500 or the Dow Jones Industrial Average. Are they consistently trending upwards? That signals a bull market. Are they experiencing sustained declines? That's your bear market indicator. Look at their daily, weekly, and monthly movements to get a sense of the current momentum.
And what about volatility? How do we spot that in real time?
For volatility, look at the size of daily price swings. If the market is moving up 3% one day and down 2% the next, that's high volatility. There are also specific indices, like the VIX, often called the Fear Index, which directly measures expected market volatility. A rising VIX indicates increasing investor uncertainty and higher anticipated volatility.
So if the market is jumping around like a spring lamb, that's high volatility. If it's more like a placid river, that's low volatility. It's about recognizing those patterns of movement.
Precisely. And for our fourth hack, let's focus on dividends. When researching companies, look for their dividend history. A company that has consistently paid and even increased its dividend over many years is often a sign of financial stability and a strong business model. These are often called dividend aristocrats or dividend champions. They can provide a steady income stream even in periods of market volatility.
That's a powerful point. A consistent dividend isn't just about income. It's also a psychological comfort, a sign that the company is robust enough to share its success, even when other market signals might be causing anxiety. It adds a layer of predictability. So, to recap the practical hacks, read financial news contextually, monitor major market indices, observe daily price swings for volatility, investigate dividend histories, and always diversify. These aren't just technical steps. They're about cultivating a discerning eye and a steady hand.
Exactly. These hacks help you move beyond passive observation to active analysis, allowing you to anticipate potential shifts rather than just reacting to them. This is the essence of building a wealth mindset.
Now let's put these concepts into a real-life scenario. Imagine it's early spring, just like now, and you're a busy urban professional, perhaps reviewing your investment portfolio. You've been hearing mixed signals. Some reports suggest a strengthening economy, while others warn of inflation. How would you apply what we've learned, Marcus?
A perfect scenario, Nora. Let's say I open my financial news app. The headlines talk about corporate earnings exceeding expectations and strong consumer spending. This immediately tells me we might be seeing signs of a continued bull market. Investor confidence seems to be holding up.